Hi guys, it's Shafman from Shafman TV. Just here in Rome on holiday, enjoying a nice espresso, and we're just looking at some investment advice for beginners. Now when I give advice to any beginner on investing, the most important thing to look at is compound interest. And the reason why compound interest is the most important thing is because, like Einstein said, it's the ninth wonder of the world. It is the way to turbocharge your portfolio, and it is really the royal road to riches. So the first thing to bear in mind is any investment decision we make, we have to benchmark it against, say, the stock market or property prices or other asset classes to see whether it's successful or not. So my first bit of advice would be invest in things which are going to compound over time and reinvest any dividends or earnings you have from those investments to increase the rate of your compound interest. So the best thing that you can do is probably buy an index tracker fund. They're low cost, they're diversified, and generally speaking, if you have a long-term view of investing, over time you're going to make more and more money, and that money is going to compound up. So, and that feeds into my second bit of advice. My second bit of advice is to be long-term. If you want to invest and build yourself a financial future, think in a long-term manner. Think in 5, 10, 15, 20 year blocks. Don't think in 12-month blocks. It's a big mistake. Any person or any business that's achieved any type of success has done it over a decade or 2 decades or a long period of time. Look at McDonald's, look at Coca-Cola, look at Warren Buffett, look at Carl Icahn, look at Richard Branson. Whatever, any example you look at, none of these people are fly-by-night. They have invested in things and they've been in it for the long haul. And this is a really important mentality point, that make long-term investments. And as I said previously, try and make investments that require very little sort of intellect. And as I say, the best thing to do is to get an index fund that tracks the FTSE 100, tracks the S&P 500, or tracks, say, the global stock market. And over a 10, 15, 20 year period, you're going to get the dividends from all those shares, and you're going to get generally inflation and the actual, your index tracker fund growing. Now, something I also advise is to consistently automate payments into your ETF or your tracker fund or your low risk investments, so that every month from your paycheck, first thing from your paycheck goes automatically as a direct debit from your current account into an index fund or an ETF, and to make an investment every single month, religiously, consistently every single month. And that will stand you in very, very, very good stead if you take, say, 20%, 30% of your paycheck or whatever you feel comfortable with, and invest consistently into something which is low risk, diversified, and as the global economy grows, your investment will grow. Now, this is a very boring piece of advice, but therein lies the beauty, because over time the compound interest is going to grow and grow and grow and make you richer and richer. Other bits of advice here are: don't take high risk gambles. Don't do things and don't enter businesses that you don't know about. Don't buy shares that you don't know anything about, and don't enter into agreements or into financial things like credit cards and other things which are against your interest. Try to have things which are in your interest constantly, So, and a low risk index tracker fund is in your interest because it's going to grow and grow over time. Another thing is, if you can, try to have 6 to 8 months money in an emergency fund. So if you work or if you have a business, don't live from paycheck to paycheck, month to month. Now, it is very obvious advice, but you know, in terms of struggling and things, but I believe there is a psychological element with living from paycheck to paycheck, which forces people to make poor economic decisions. So when you're living from paycheck to paycheck, you know, you feel demoralized often. You feel like you know, you need to go and drink, or you need to buy things to boost you up and make you feel good, and that means that you lose money. On the flip side, when you get into the habit of having a 6 to 8 month reserve of money, having your direct debit into your low risk investment, and having money to sort of enjoy your life, it really boosts your morale. But when you've got credit card debt and lots of debt and high interest debt that you're having to service, you feel like you're on a treadmill and you feel demoralized. So that's more of a psychological point, but that obviously is very you know, obvious advice, but I'd advise people to do it. So let's just briefly recap. We want to have 6 to 8 month reserve of money. We want to be investing money into the stock market, or into mutual funds, or into ETFs, or into tracker funds, low risk, monthly, consistent, systematic investment. And we also want to avoid things that we don't know anything about. And I think that these 3 little nuggets of advice are very good places to start for beginners in investment, because I'll give you one small caveat, is that cash is not king. Cash is a bad investment over time, and businesses and stocks that generate more and more cash flow over time are going to beat inflation and grow your wealth, you know, with the global economy. So I hope that video has been useful. Please subscribe to Shafman TV, and I hope you have a fantastic day. I'm going to walk around Rome, drink some more espressos, eat some more cakes, and look at the beautiful buildings there. So keep on investing. Thank you.